Welcome back to another episode. This is us talking about our BDRA program, which is our retirement rollover product. And I am joined today by Ben Morris, the founder of our BDRA program. He knows it better than anybody else. Between you and me, every single time I talk to Ben, I learn something new. He's very knowledgeable about stuff that is very interesting to me. So stay tuned. You're going to hear some interesting stuff. Ben, thank you again for coming on the show.
Thanks, Tim. It's always a pleasure.
Good, man. We picked out our mugs today. So what mug did you pick and why?
I picked complaining is not a strategy, just like hope is not a strategy.
Right? Why isn't complaining a strategy? I mean, I know some people that complain a lot. Are you saying it doesn't?
Because it's ineffective.
All right,
Just
perfect.
shut up and start working.
Yeah, mine is less meetings, more doing. But of course, stay in this meeting right here because there's going to be some good stuff coming. All right, so BDRA, we'll talk about what the heck that is. But this show is about 401K rollovers. Mm-hmm. And if you've heard me talk before about 401K rollovers, I always say the same thing. I say that it is the absolute best way to finance your business, right?
Yep.
You got anything to say about that? You agree?
Yeah, no, absolutely. It's the best way to finance your business. No debt involved, no banks. It's just you and your retirement account and no taxes.
Awesome. All right, well, we're going to get a lot more into this. If you're new to the show, subscribe. Your subscriptions and your likes, maybe like the show right now. I'd love it if you like it. Your likes and subscribes help more people just like you. All right, so jumping right into this. What is BDRA? What do the letters stand for? What's it mean?
Yeah, a business-directed retirement account. BDRA stands for Business Directed Retirement Account. It is a way to get your retirement assets into your business without paying any tax or penalties, without any distributions showing up on your personal income. It's totally approved by the IRS. They know what this transaction is. They say as long as you do it the right way, it's perfectly compliant. Okay,
so BDRA, Business Directed Retirement Account. Where did that term come from?
Well, we use this term because we want something that sounds similar to a self-directed IRA. And a BDRA is very similar to this type of transaction. Self-directed IRA is for passive investments, things that you're not involved in, but we want to use these funds for something you are involved in. A hands-on business where you're an employee, you're taking a salary. So it's, instead of self-directed, it's business-directed.
All right, so that's not an IRS term. That's a term that you came up with yourself because you feel like it best defines what it is. What are some of the other terms? We have a list of some of the other terms here that people use to describe this. What are some of the other things that this is called?
Yeah, so I feel like BDRA is the most accessible term. That's why I throw it out there. Some of the terms you might hear are 401K rollover or rollover as business startups, the term that the IRS uses, or 401K business funding.
That's the one that I don't like. Rob's, right? You're not robbing your retirement account. You're liberating it. You're liberating it from the 3 to 4% that you might get in the market and giving yourself the ability to invest in your own business. You can double it in a year if your business does well. You'll never get those returns in the market. So 401K rollover, if you go Google 401K rollover, 98% of what you're going to find is people that go from one job to another. They're just looking to roll their retirement account from their old company to the new company. So that is not a good description of what it is. Rob's is definitely not it. Right. So business-directed retirement account. And that means you've now got a retirement account that's focused on your business, not just a benefit to the employees, but a benefit to the business.
Yeah, you're absolutely right. Instead of growing your money in the stock market, you're growing it in your own business. As you're saying, I'm an entrepreneur or I know this profession. I think that if I invest in my own profession, I can do better and earn better returns than the stock market.
Yeah, I mean, you should be able to grow your business, maybe 20% per year if you're doing well. If you believe in yourself enough to start a business, then probably you believe in yourself in order to invest in yourself. So we have some example clients that we've helped in the past. Here's a laser skincare facility. They got $250,000. Is there anything you could tell us about this client that's interesting?
Mostly it was the time frame for funding. 23 days is kind of a standard time frame for this rollover program. But really it was the type of retirement account they had, where it was coming from, and the state that they were incorporating in. It's generally a long time frame. So this should have taken 35 days if we did incorporation first and then the rollover. But we reduced that to 23 days by doing them at the same time. So we started the incorporation process, got the articles filed, and while we were waiting for those to come back, we actually contacted their custodian and said, hey, we're looking to start a rollover. So there are a lot of ways that we can reduce the time frame for completion, and that was one of them.
And 23 days, and people don't really care how long it takes to get their money, right?
No, that's all that matters is when they get their money.
That's what people care about, right? Because you got a business, you got an opportunity, you want to take advantage of it. We can get you the funding faster than most other people. I believe there's other ways you can do this, other service providers. Most of them kind of leave it to you to do it yourself. And frankly, our clients are not experts in retirement rollovers. So everything that this service does is done by licensed professionals who've done hundreds, if not thousands, of these transactions and know how it works, right?
Certainly.
Okay. All right, here's an ice cream shop. They got $25,000 in funding for the retirement account. That is a pretty small amount. What are the normal parameters that people get?
So normally when we talk about the cost versus the alternative of just pulling the money out, we really want to make sure that it's a good fit by avoiding tax and penalties. You know, you're talking about the 10% early withdrawal penalty and then normal income tax. And for most withdrawals, that's going to be well over $10,000. So for $25,000, it's just barely over that. So we don't really want to come close to that with our own costs. But the times when it is a good fit is when that $25,000 is the necessary piece to other funding. And that's what happened with this ice cream shop is they already had most of their cash injection. The bank came back and said, you know what, based on your credit and your situation and you're taking over this business, we actually need 20% instead of 15%. And so they needed an extra cash injection that they didn't have in their personal coffers. They didn't have from other lending or family members. And this was holding up a $400,000 loan. So that's why in this case, it made sense to the client. They were willing to pay for the fee. And even though it wasn't as cost beneficial as most of our clients, it was absolutely necessary for them to start their business or acquire this ice cream shop.
Okay, that makes sense. So, and that brings up an important point. A lot of our customers for the retirement rollover product actually use the money in order to facilitate an SBA loan. If you're looking to acquire a business, typically you need to put in anywhere from 10 to 25% of the purchase. It really depends on the type of business, how much you have to put in. And if you have everything to go except for not enough capital for that capital injection, you could do a retirement rollover. It's one of the most common ways that we see this transaction happening. The most common things I see are business acquisitions and franchises, people starting a new franchise. What else do you see a lot of?
Retail food. So outside
retail
of
food.
Franchise retail food, a lot of people starting their own mom and pop shop with sandwiches, coffee, food trucks.
Everybody's got to eat, right? Food trucks. Love the food trucks, man. Okay, we just had another example up there, which is a FedEx route, which, again, if you watch the show, you know that we have facilitated a heck of a lot of FedEx routes. Is a FedEx considered a franchise? What is a FedEx route?
Technically, it's a business opportunity. You buy the route. So there's no branding. It's not like you're
FedEx,
out there.
Right?
Well, you're not out there marketing saying use my route. You're literally just saying here's the zip code or here's the addresses that I'm going to deliver for FedEx. So you're not quite an employee. You
don't do any marketing.
You don't do any marketing.
You just work the routes that they give you, and they provide all the work.
Yeah, you just show up at the processing center and you deliver the packages, and there's nothing else to do other than just work the job.
That's weird to me. By the way, I'm really into business models. That's like my thing. And it'd be weird to get in a business where it could go up or go down and you have no control over it. But anyway, lots of FedEx routes, and that one I missed the details on there because the slide went away.
It's $150,000.
$150K. Now, cost. There's been a cost on a couple of these slides. I've noticed some of them are $54.95, some of them are $59.95.
Sure.
$500 difference. What's the difference? Is it different states or?
We'll talk about it in a little bit, but it really is based on payment options.
Payment options,
we are a little bit flexible on when our clients pay or how they pay, and that can affect the price.
I like flexible. All right. So what is a BDRA? Let's go into a little more detail. We got some. These are some of the steps on what happens. Why don't you explain what happens if you do a BDRA with us?
Yeah. Really, it boils down to 3 steps. We need to create an entity, a corporation that can receive these monies. We have to create a 401k plan that allows for this non-traditional investment, and then we have to actually move the money and go through the transaction of buying these shares. So those steps in that order is one, first create the entity, second create the 401k plan, and it needs to be customized to the client's business. It also needs to include the special language that says you can invest retirement dollars into the corporation. And then lastly, moving the money is something that shouldn't be left up to a client, mostly because their interaction with their custodian. The custodian already has their money. They don't want to let it go. They're losing that relationship a lot of times.
Right.
And so they'll make it difficult for the client. A lot of times they'll also botch it, maybe sometimes intentionally, because they don't want that money to move. And it's costly for the client. They might receive a 1099 at the end of the year saying that they took a distribution, and we have to help them fight that. So we take all that off their hands and say, you know what, we're going to deal with your custodian as much as possible. We'll only have you on the line if it's absolutely necessary. And that alleviates a lot of these problems because there's no relationship there. We're saying the money's leaving, you don't have a choice, your client decided to move it elsewhere.
Okay. Now, I feel like a lot of people get confused as to what the process is, even though we just said it. I'm going to say it again in what I think is the most simplest terms possible, because if you have money in a 401k and you're watching this and you're thinking about it, you may have never thought about using that for your business before. You're thinking 401k is, first of all, your money is in someone else's 401k. It's in someone else's account, and then there's somebody who's trading that money for you. You have some control over what you want, but it's invested in the market, right? So what we're doing is we form a new corporate entity. We create a corporation for you, and that's included in the cost, right? You get corporate entity formation done. Create a new company for you. We create a new 401k plan in your business. Now, you as an investor, you roll your money from the old 401k to the new 401k. Now, just like before, your money is in a 401k. Same thing. The only difference is now with this 401k, we modify it so that one of the investments that's available to you is investing in your own business. And when you actually invest, what happens is money goes from your account into the business because you buy shares. Your investment fund buys shares in the business. Now, as your business grows and is a huge success, your investment grows. And at some point in the future, the business buys back its shares from you, giving you the huge return. You could triple, quadruple your money. I mean, heck, man, you could do a lot more than that, right? You can have a pretty big success. So that is, in simple terms, exactly what a 401k rollover, a BDRA process is. You're creating a new 401k, which is a benefit to your employees, where you can now invest in the business. Does that mean your employees can invest in your business also 2-3 years from now?
No, this is a limited time offering. It really is only for the business owner. Now, there are legally, there are some steps you have to take to disclose it to employees, offer it to employees, but only for the duration of the offering. So that's about 12 months. Once that closed down, you don't have to tell anybody about it or let employees participate. Now, the 401k plan, that's always a fixture of the business, and you should continue to offer it to your employees. Let them take their own wages and buy mutual funds, but not necessarily your company stock.
Yeah, I think a lot of business owners think that having a 401k as a benefit for their employees means that they have to do matching. There is no obligation for that. You can have a 401k, and it's just a way for your employees to set money aside in an investment fund. All right, so what are the basic rules to work with us? So that last client we had showed a $25,000 transaction, which was a small amount. But of course they're paying that money, they're getting a corporate entity formed, so there's real value there. But in general, what's the smallest deal you've done, and what's the biggest deal you've done?
So, I mean, yeah, certainly 25K is about the smallest. I don't think I've done anything less than that. And the biggest being, 1.3 million.
Okay.
And that was actually multiple accounts. So that was an entire 401k plan was moved from one custodian to another.
Oh,
and
that sounds complicated.
3 of the participants wanted to buy their company stock. So that's probably the largest. But in general, what we're looking for is usually people that just have their own retirement account that was from a previous employer or in an IRA. Usually about $35,000 is when it starts to make sense as far as the cost is concerned. And certainly anything over $50,000 is a really great benefit. So we're really looking for anything $50,000 or more, but certainly with $25,000, $35,000, we just need to evaluate the situation to make sure it's still a good fit for the client.
All right, now the account has to be from a previous employer. And from what I've seen, this is the biggest potential hang-up, that there's just no wiggle room on that, right?
Yeah, in general, there's no wiggle room. There are, very seldom there are exceptions to that rule. And we'll go over the types of accounts that are accessible.
But that means you got to quit your job. If you want to do this and you're working somewhere and you got a 401k, you got to quit your job and leave. I was talking to somebody about this the other day, and they asked, well, how long do I have to wait after I quit my job? So now I got you here, you can answer.
Sure.
How long does it take?
So it's based on the employer, but generally they have 30 days. They say
they must wait 30 days at least generally.
No. It's actually instant. It usually takes about a week or two for the employer to communicate to the retirement plan, hey, this employee is terminated. But most plans will allow the employer a maximum of 30 days to cut you a check. So they can say, hey, we're going to get you a check from your retirement account as soon as you quit, but if it takes us 30 days, then we're still within our legal rights to do so.
All right.
So that's really centralized to 401k plans, different types of accounts like employee stock ownership programs. They might have longer time frames.
Yeah, I remember we had some client that had to wait 6 months or something, and then there was only a certain time a year they could access it. Yeah. Some weird stuff in there, right? But in general, it's not. Most people, you can say, take this job and shove it, walk away, get your cash, and start a business. I know it's a big step. Thinking, I'm working at this job, now I'm going to quit and go start a business. It's a big step, but the good news is you're able to access the money right away.
Well, one of the great things about using your retirement account for that big step is if you just borrowed the money, then you would have to immediately start making repayments. You'd have to service that debt. And that can be very hard for somebody that's just quit their job because they're trying to hold on to the money that they already had, maybe to pay their personal bills. And so when they're looking at a $1,000 or $2,000 monthly payment on their business loan, that can be crippling for a brand new business and for somebody that's just quit their job.
Right.
With using your retirement account, there's no obligation to pay that back on any specific time frame. So
there's at some point you got to put the money back, right? I mean, there's some rule. Isn't there a 3-year rule or something? Or
no, you do run into required minimum distributions, but that's when you're 70 and a half.
Okay, so you got a little time.
Yeah,
most people.
A little bit of time.
Okay, all right. So, and by the way, I've talked to thousands of business owners. And when you go and start a business, it never happens like you expect. Sometimes it blows up quickly and you get a ton of business. More frequently, it takes a little bit longer for you to reach profitability. Not having a monthly payment is a huge benefit. That is, among everything else, why I say this is the best possible way to finance your business, because you have no investor you have to answer to except for yourself, and you can give yourself some slack, right? You have no debt payments, and you have no obligation for repayment within a short time frame now. So grow your business and end up putting a bigger return in your retirement account than you would ever get in the market. So that's great, great, and great. No tax penalties also. Most people think you're pulling money out of my 401k, Uncle Sam is going to kick me in the teeth.
Yeah.
Not the case.
Mm-hmm.
All right, cool.
And the main reason is that we're not pulling the money out of the retirement account. We keep it in a retirement account. All we're doing is we're taking control of how you grow it. Generally, you grow your retirement account in the stock market. So you're giving control to Fortune 500 companies. You're saying Apple, IBM, MetLife. You're saying to them, I think you know how to run a business. I'm going to trust you to grow my retirement account, which is true. Those companies are good at what they do, but they're also good at making money for themselves, first and foremost. So what you're doing is you're taking control away from the Fortune 500 companies in the stock market and saying, it goes up and down. I maybe don't trust it as much as I used to, but I do trust my own business and my own ability to be an entrepreneur and earn a return from my retirement account. But the structure is staying the same. You're still tax deferred, and that's why the IRS says it's totally fine to fund your business this way. No taxes and penalties.
Now, in the franchise industry, I feel like it's just known. A lot of people do retirement rollovers. It's very normal.
Sure.
When you get outside the franchise industry, and I present this to business owners, I often get an immediate reaction of, whoa, I'm not going to touch my retirement account. So what do you say to people that feel like that?
Well, I always focus on their own business, and I try to explain it from the point of view of a bank. When you're going to a bank, you have to pitch your own idea. You have to say, this is why I am bankable. You should give me money to start my business because I believe I can make a lot of money. I believe I have a good business plan. And I am a professional. I've been in this industry for 20 years or so, and this is why I think I can make money. So I would have that conversation with myself. If you were the bank, if your retirement account was a bank, and you could go to it and say, "Hey, you should bank on me because I'm an entrepreneur. I know what I'm doing." Would your retirement account say yes or no? That's a good investment.
All right. Interesting way to look at it. Yeah. All right. Good. So what are some of the unique benefits of our service as opposed to going out? There's websites that show you how to do a retirement rollover on your own. Scary, by the way. That's scary. That's clearly not the guy before who said he'd never touch a retirement account. Somebody who does that is somebody who's willing to throw their retirement account in the trash can and just hope it doesn't burn up. But what are some of the unique benefits of our service compared to some of the other ways to do this?
Really, the consultation. We feel very heavily that this is an ongoing relationship. It's not a transaction. The IRS is less concerned with the original setup because there is a precedent for that. Many people have done this already, so they know what the structure looks like, and then they've approved it. Where there is a lot of pitfalls is in the ongoing compliance, the ongoing management of having a 401k plan in a corporation. What do I have to file every year? What do I have to show to my employees? What do I have to tell my CPA? Those are the pitfalls that most people run into if they were trying to do this on their own.
So are there a lot of filings that your customers need to do on a regular basis because of this?
Annually, yeah, there's usually one filing that they have to do annually for their corporation and one for their 401k plan, and then tax reports for both.
And is that done by the plan administrator, or is that something they do on their own?
So the plan administration would take care of everything with the 401k plan. That is the hardest chunk of this. The most work goes into the 401k plan, so that's taken off your shoulders.
All right, so that's not a new thing that business owners have to do, because the 401k plan administrator handles all that?
Correct. It's usually something that they have zero experience doing, and
I don't know. I wouldn't know.
You would absolutely botch, plan administration if you try to do it yourself.
Yeah.
The Department of Labor actually requires you to pay somebody to do it for you. That's how strongly they feel.
Hey, there you go. Perfect. And that's part of this.
Yes, absolutely.
Okay, great.
What's not part of it is the corporate filing. So like having an annual report for a corporation, it's not something that most business owners have ever done before, but it's something that's so simple that's not an issue.
What's the annual report? Is it their tax returns or it's something different?
No, this is with the Secretary of State. So when you go to the Secretary of State,
because it's a security that basically, right? Is that what it is?
No, nothing like that. Anytime you have an entity, if you have an LLC or corporation, you've told the Secretary of State, I have created a separate entity for myself. Well, they want to know annually, has the address changed? Have the owners changed?
Oh, you're talking the statement of information.
Exactly.
Okay, right.
So that's something that most business owners have not done before.
Everybody has to do it. Has nothing to do with
Everybody's got to do it.
Right?
It's a simple form, so we focus on reminding you when it's due and making sure that you actually file it and making it easy for you. We actually have a service where we'll actually do it for you for a little extra cash.
Nice. All right. Okay, so this has been around in one form or another since, I believe, 1974 is when they passed the law. Is that right?
Yeah, so the law that makes this possible has been around since 1974. All
right, so
however,
how's
it wasn't utilized really until 2001.
2001 is when it started. Yeah. Okay, so what's been happening? What changes have happened in the last couple of years? What do you see on the horizon? Let's talk about the current market a little bit.
So as I mentioned, 2001 is when people really started to take their retirement account in their own hands and use a BDRA. But in 2008, we saw the stock market crash. We went through recession.
There was a crash?
Yeah, you might have heard of it. Housing market
pretty ugly.
So banks, tightened their belts. They said, "Hey, we're not going to lend anybody. We don't want to, fund any businesses anymore. No more $300,000 business loans just on your credit."
Yeah, that was nice. My job was a lot easier in 2006 and 2007.
And but the market rebounded, and now we're seeing, we're in the middle or the tail end of a bull market, and we're seeing great returns on retirement accounts. And so people have started to kind of back away from using their retirement account in the same way that they were, in 2008, where it was like, oh, screw the stock market, I'm going to take matters into my own hands. But what people forget very easily. But now we're in that same situation.
But the market's going to go up forever.
Yeah.
Trump said so. It's going up.
I think
I'm not sick of winning yet. I'm loving it.
Well, probably within the next 6 to 12 months, maybe as many as 18 months, the bull market's going to end. At some point, we'll see a dip, and people are going to get scared, and they're not going to want to stay in the stock market anymore.
Right.
Well, that would be a great time for them to consider investing in their own business instead.
I've seen a lot of people. What happened before was a lot of people went through the correction, and now their 401k was literally half of what it was before the thing started. And then they pulled the money out for some other purpose. Well, heck, man, do it before the darn thing drops while you have more money in there. This is a good time to pull out because it's been going for a long time. I know this is a little bit off, but I was reading a report this morning that KKR, which is the biggest, I think the biggest private equity fund in the world, issued a warning that they predict there's going to be the beginning of a downturn within the next 12 months. And by the way, I know this is, again, a little...
Where do you think I got my information from?
Is it from KKR directly from? Yeah. But I mean, was it from that report? Did you read the same thing? Oh, you read the same thing I did. And it's interesting to me because these private equity funds are loading up public entities with mountains of debt. So if there is a correction, that's why there was such a big spike a couple weeks ago. So if there's a correction and interest rates start going up, it means trouble for maybe 40% of the U.S. companies that are owned by private equity funds. So it's a real thing. There could be a big correction because of that one thing. So if you have money in, it's good to pull it out and invest it in something that's not, like your own business. That could, if you have a counter-cyclical business that's going to benefit in a downturn, now's the time to start it so that you're ready when it comes.
Yeah, I have a lot of smart clients calling up saying, "Hey, I'm enjoying the returns I'm getting, but I want to get out now."
Right. Good time to get out. Now, somebody's asking, does the client have to incorporate by themselves, or do we help with that? That's definitely part of the process. They get a free incorporation as a part of the retirement rollover process. But what happens sometimes is I get people to say, hey, I already formed my corporate entity. I got this LLC for the last 6 months. Can I use that? Do I need to use, what happens with that?
Sure. So there is a pretty specific requirement on the type of entity and some issues with the shares that are authorized. But the bottom line is we'll either create the entity for you or we'll take a look at your existing entity and make the necessary changes to make this type of investment possible.
Okay, great. All right, so let's talk about who qualifies, who doesn't qualify. I think we have a little section where we go through our requirements and ideals. So there's 2 primary criteria. What are the criteria again?
Well, the first is that this must come from a retirement account. And then I think one of the next slides is about what kind of retirement accounts can be used. And then these assets can't be from contributions you just made with your employer. So it says you must not currently be employed. You can be employed, but the retirement account shouldn't be from your current employer.
Okay, so if I worked at one job for 20 years, switched to a new job a year ago, and then all of the money in my 401k was from the prior employer, not my current employer, then I can roll the funds over?
Absolutely.
What if I invest 20 years at one place, 1 year at the new place, and I put some money in the new place? Can I access the old money and just not the new money, or at that point it's all just...
Usually, yes. So in your scenario, let's say you have been working at this new job for a year and you finally got eligible for the 401k plan, so you said, you know what, I'm going to take my old plan and roll it into this one. Most 401k plans will say you can't touch the money that we are contributing, but you can touch the money that you rolled into our plan. So that's why it's very important, not necessarily to try to qualify yourself, but just to get in contact with us, send us a statement over. I will review it, or one of our other processors will review it and tell you, yes, this is accessible, or no, that's not accessible. So yeah, we're giving the rules of general rules of qualification. It shouldn't generally be from contributions at your new employer, but there are so many different variables and exceptions that it's really important to have a professional look at it.
Yeah, like one of the exceptions that I found out, what I was pretty happy about, is I had 2 business owners. They owned their own business. They had their own 401k in their own business already, and they were working there, getting paid. And I thought, okay, that's the business they got the money from, so they can't do it. But that's one of the exceptions is if you already own your own, if you are one of the owners in the business, you could potentially roll over that money, right?
Yeah, absolutely. So that's a great example of a huge exception to the rule. Is if it's your business and your plan, you don't have to do a rollover. We'll take over the existing plan and we'll add this QS BDRA investment to that existing plan.
All right, now we had a crazy big list. I think, why don't you put that back up again and we're going to talk through it a little bit. I apologize, especially if you're on a mobile phone. There's no way you're going to be able to read this. There's a lot of stuff on here. But as we were discussing before the show, this is the #1 thing I get questions about. Will my plan qualify? There's a lot of different kinds of plans. So why don't you just kind of go through these? 401k.
Yeah, so if your retirement account has a number in it, if it's 401k, 403b, 457a, those are accessible. They're all the same type of account.
Okay.
So this is an employer plan where you've put money into it from your paycheck and maybe the employer's matched it, but the assets belong to you. The money belongs to you, and as long as you've quit or terminated with the original employer, then that should be accessible.
Okay.
Yeah, a lot of these other ones have to do with where the money's invested, like an annuity or life insurance. Those are difficult investments and something that we should review because the answer might be yes, but it's most often no. So again,
an annuity is something where they agree to pay you a certain amount.
An annuity is a contract with a life insurance or an insurance company. So with an annuity, you're saying, I won't move my money for 10 years, and you're going to give me a nice return, usually 7 to 10%. But there are extreme penalties for touching that money or pulling the money out.
And then they just hope you die, basically.
No, they use this money to bond their insurance policies. So they have, hundreds and thousands of people that have, entered into these contracts with them, and then they use that money to go and bond insurance that they can then, write insurance policies off of. So they don't actually use your money necessarily; they use it for bonds.
Okay, great. All right, so this annuity is designated Roth account. That's a yes. What's the difference between a designated Roth or a Roth? Is there a difference?
So most common you hear Roth IRA, and that's something where it's your individual account. A designated Roth account is actually a Roth portion of an employer account, which again is totally fine. But a Roth IRA is something we can pretty much never use.
Okay. An ESOP, when can you use an employee stock ownership plan and when can you not? So it doesn't sound like something that you could use.
Yeah,
frankly.
And this goes back to your example of having to wait 6 months, only distributions on a quarterly basis. An employee stock ownership program is when the employer has allowed you to buy their stock. And so your assets aren't in the stock market. Your assets are in their corporate checking account. So if you quit or if you ask to pull this money out, they have to dip in their own coffers to pay you out. And so they'll put a lot of rules on these types of accounts. They'll say, we have 2 years to pay you, or we can pay you in tranches of X number of dollars. So it gets very complicated, and a lot of times they make it very, very difficult for you to pull these monies out. But it still belongs to you, it's still your account, and we certainly can use it. It's just going to be difficult to get the money out.
Okay, great. Now I saw a question come in, and so I want to explain what you're looking at here. The question is, why is a Roth IRA not a retirement account? And I want to specify that yes, no is not saying that it is or is not a retirement account. We're talking about is it or is it not qualified to be used as a retirement rollover. So a Roth IRA, you cannot roll it over because we just lost the screen there, Darren.
Actually, that is a typo. It is a retirement account. So that that's information on the wrong line.
Wait,
that was supposed to be for life insurance.
Oh, it says not a retirement account.
Yeah,
it actually says it on there.
It looks like these got mixed up a little bit. A Roth IRA is certainly a retirement account, but the IRS does not allow Roth IRAs to be rolled into qualified plans.
Marcy always catches our typos. Darn it. Marcy. Okay, you're right. It is a retirement account. Good. All right, what else on here? Life insurance.
Yeah, that's what this line was supposed to be for. Life insurance is not a retirement account and can't be used.
Money purchase. What's that mean, money purchase?
A
money purchase plan. What is that?
This is similar to like a money market account.
Okay.
So it's usually a low interest, unsecured or not FDIC insured account. But it really doesn't have anything to do with the type of retirement account. It's the type of investment. And so the reason we put those up there is because a lot of people, they may only know their retirement account based on the investment type and not necessarily based on the tax structure.
Okay.
But what we want you to take away from this is that there are many, many different retirement accounts, and regardless of what you have,
Ben knows them all.
Know them all.
He can answer your questions.
And if you send over a statement, we can review it and say yes or no.
A stocks bonus plan, you can use that. I'm just shocked. Simple IRA. A simple IRA is just an IRA, right?
A simple IRA
is it different than an
something
IRA?
that came from a qualified plan, employer plan, and is currently in an IRA. So it's usually a transitional account.
All right. A lot of stuff there.
Yeah.
Cool. Ben can answer your questions. Let's move on because that's a lot. All right. When can you not based on the type of account, but when can you have qualified money, meaning you're allowed to use it for a rollover, but you're not allowed to use it? That's what this next section is.
So there are a few business models that we just can't use this for. Certainly anything illegal, but specifically day traders, Forex currency trading, it's considered not
What about buying
active
Bitcoin?
business.
Can I use it to buy Bitcoin?
Absolutely not. No. and
that's a good thing, probably.
But you can buy Bitcoin out of a self-directed IRA. So we
Okay.
also have methods for that. And the 401k plans that we're designing, we're actually bringing Bitcoin into the investment lineup. So that can't be your primary business, but it could be available to you as an investment inside the plan.
Okay, let me point that out, right? If you roll over your retirement funds, this is a question I've heard a number of times. Let's say you got $1 million. You roll over $1 million, but you only want to put half into the business. The other half you could still invest just like you would in your normal retirement account. And anything that's a qualified investment, that would be through the retirement plan processing. And you're saying now people can invest in Bitcoin through their retirement accounts.
Soon.
Soon,
Yeah.
okay.
But,
all right, well,
but absolutely.
good luck with that.
Traditional
Could be great,
investments
could
or
be horrible.
non-traditional investments are available in the plan. But what we're talking about is the business that is sponsoring the 401k plan. What you're actually using most of the money for needs to be an active business. And so we can't have your active business or your main company be an investment company. Because by the nature of that, day trading, forex trading, investment companies or holding companies, those are inherently passive. Same thing with like precious metals. There's no business taking place. You're not, buying a product, providing a service, or a product. You're banking on the day-to-day changes in the value of something.
So let's say you buy sports memorabilia and you have a store where you sell it. That's an active business.
Absolutely.
But if you buy gold and try to sell the gold, that's not an active business.
Correct.
Okay.
Now, there are some industries that I'm not comfortable working with. Drop shipping is a big one because, again, it falls under the assumption that there's not a lot of active business. You put your website up, somebody else is shipping it, and there really is no business. And it's also a business model that we've really struggled with this structure. Now, there are other ways to fund that, but not with this retirement.
Yeah, it's a tough one. If you're thinking about buying into a drop shipping opportunity, might not be a good idea. What's some of the weirder businesses? Tell me the weirdest business.
The one that got me was trauma scene cleanup.
Oh man,
that's a rough one. It was an ex-cop, and his business was doing what nobody else was willing to do.
Yeah,
and it was extremely lucrative.
Not willing.
Yeah,
not willing.
So the guy was making $3,000 a day. But I couldn't stomach it.
Wow, is that a franchise you can buy into?
Nope.
Man,
no one's franchising that.
They actually made a TV show where that was the main premise. So.
Yeah, but then they get involved in crime, right? So that's I think I saw what you're talking about. No, that's definitely something I wouldn't want to do. Okay, that's interesting. All right, so more prohibitive structures are holding companies, shell corps, commerce within a controlled group. What's that?
Yeah, so there are still some restrictions. Although this is a very flexible structure, there are things that you can't do. Like, let's say you have an auto shop and you want to start an ice cream shop. And you fund your ice cream shop with your retirement account. We've set up a structure that makes it possible. And all of a sudden, your auto shop, one of your pieces of equipment breaks down. Mm-hmm. You can't move money from the ice cream shop to the auto shop to fix things, or you can't loan money back and forth. You can't have those businesses occupy the same space. You can't lease, have at least.
Can't be in the same space.
Yeah,
that's interesting.
Because your auto shop is considered a prohibited entity. It can't have any business with your retirement account because it's owned by you personally. So there are still some boundaries that we really can't cross. Now, there's alternatives to that. We can make changes to the structure and make that possible. But in general, if you have an existing business, you can't have them interacting with each other in this way.
Okay, and international businesses. So if I ship things to Mexico, is that international, or does that mean a business is actually in Mexico?
The latter. So you certainly can have a US-based business that either transacts business overseas or actually has operations overseas, as long as the entity itself and the main company are US-based.
Okay. Now here it says banned or illegal items retail. I guess what that means is if you're retailing banned items, right?
Yeah.
You can't do that. And by banned, we're talking about actually illegal stuff. So the question that comes up the most, I know you've already heard it a bunch, and I think our position has maybe changed over time. So I'm curious to hear what the answer is. Marijuana, is it legal or illegal? And can you open a shop or a grow or whatever with retirement funds?
Well, if it's legal in your state, then it's not illegal. No.
Okay.
So, certainly narcotics. If your business is retailing, narcotics, then
I was going to open a crack shop. I was going to start selling crack with my retirement. But marijuana is okay.
Yeah, I mean, if you're in the industry, you already know what the legislation is, and you know how to stay compliant. And what we've seen is in states like Washington and Oregon, the certifications and the regulation on cannabis is actually more strict than alcohol. So
really,
or even food. So the way we look at it is, if you're creating moonshine, and selling that, like, that's not legal. But there's nothing wrong with owning a bar. The way that these states have implemented cannabis is, again, so heavily regulated that it's impossible to consider that really illegal.
Is it like that here in California too? Have you seen that?
Not yet.
No? It's still Wild West?
Yeah.
I don't know anything. Okay. All right. So other restricted uses, your own house. What if your business is in your home and you want to build a shed to rent tractors out of? I'm just making this up, but is that something you could do? That'd be a no.
That'd be a no, because
Nothing
that's your
at
primary
your house.
residence that you're adding a business to. Just like if somebody says, "Oh, well, my office is my garage," like that's not okay.
What if you live on your farm?
That's potentially different. A good example I have of this is a country store. Or a country general store. I had a client that was acquiring a country general store. On the premises, there was an upstairs apartment, for operators to live in. But there was it's a commercial property. It's got retail location on it. It also had a concert hall. They were leasing farm equipment out of it. So it's definitely a business commercial property. Now, if that has living quarters, then that's certainly permitted. But you can see the difference in there. We're talking about commercial business that you live at, permitted. But if it's your residence and you're trying to build a business out of it, then we wouldn't be able to use this money for the residence. You could still use it for the business. Okay. But you couldn't use it to improve your kitchen or improve even the office space that you're using. That'd be prohibited.
Okay. I know in the CRE, in our commercial real estate program, the use that we have to determine whether or not it's owner occupied or not is that no more than 20% of the property can be for owner residence type stuff. So if you have a farm and the house is 50% of the land, not going to go. But as long as the house and everything there is less than 20%, then it qualifies. It might be something
Another good
similar.
example is bed and breakfast. I have done a lot of those. So that's a clear definition where they're living on a residence. I mean, it's not necessarily a commercial property, but the 80-20 rule applies there. And so most of the rooms are either communal or specifically used for their customers, and the living quarters are very small.
Okay. Now I see somebody asking a question which, frankly, I know you already know the answer to. Maybe it's a layup, but can you combine, because I know you've done this. It's a retirement rollover that Brett gave us with somebody where there were 3 or 4 different people using a retirement account. So the question is, can I combine multiple 401ks into one company? How does that work? Yeah, so
by nature, a 401k plan is for all employees of the company. So certainly if you have a couple business partners that they want to use this structure, it's going to be set up for to be inclusive for all of them.
What if somebody else? What if you do your own, and a year later somebody wants to come in as a partner and invest? So if when can or cannot do it?
If they want to bring in just their own cash, then we can certainly facilitate that. If they want to bring in their own retirement account, the offering may have closed, and so we might have to reopen that.
Okay, so you can reopen it.
You can certainly do that. There might be some caveats or some hoops that we have to jump through, but absolutely yes.
Okay, great, awesome. All right, moving on, Darren, from the restricted uses. Next, we're coming to the process. Let's talk a little bit about the process. Let's try to do, actually, when we start this process, it first starts that if you're new to finance agents, you know that we have a network of over 20,000 people that refer prospects to us for funding. So the process goes like this. One of our finance agents does marketing or puts it out there that funding is available. They create a lead. It comes into one of our member offices. There's 4 different ways for them to create a lead. They either manually enter into the system or mark it with their link, or they send an email off to a certain email account, or they just call up their rep and they talk. But one of those ways, they get the information to us. It goes to one of our member offices. Our member offices are trained in all the different types of financing, and they'll talk to your client and see if a retirement rollover is indeed the best possible way to finance their business. Usually the question is, can they? Because if they can, this is the way to go. And if they can, they'll do that. Otherwise, they'll look at other types of financing, or sometimes we'll blend it together. After they've determined that it works, then the member office will send up the sign-up agreement. I mean, it's pretty straightforward. Was it a few pages? And what kind of stuff they have to provide in order to be able to proceed? Well,
hopefully they've already provided that statement. That's the main requirement.
Is a statement from their retirement account.
Yeah. So
does it have to be this month? So if it's 6 months old, does it matter how current it is?
6 months old is perfectly fine. So we understand that a lot of these statements come quarterly, so it's not like a credit report where there's items that are going to show up in the last minute that might make it difficult.
Good, because that's annoying.
Yeah, absolutely.
But there's not a lot of gotchas, so you don't see a lot of people that fall out for some weird reason.
No.
Okay, great.
But there might be an extra step in there. A lot of times when the client has submitted their statement, they're interested, then we send out the engagement agreement. They say, well, I'm still not sold, or I still have questions. That's usually where I might get involved with the agent and say, let's call them together. Let's make sure that we answer any questions that they still have.
Or I say a lot of the time is you're talking to the CPA, right? When people go to their CPA, does that end up being a hurdle, or how does that? Do CPAs tell people, hey, don't touch your retirement funds? Is that
usually.
You get that a lot?
So it's definitely a hurdle, but there's a lasting benefit that comes from it. Because first and foremost, I want their CPA to be on board. There is a lot of compliance that we do, but at the end of the day, the CPA is the one that's going to have to file the tax return. They're the one that has to communicate to the IRS who the owners of the 401k or the corporation are. And so they have a very integral part in this process. So I need to make sure that they're on board. But it only takes about 5 minutes to explain the structure. They don't have to have any prior knowledge of this. It's really more important that the client trusts them and that they're involved in their industry. And then also out of that is I get a lot of good relationships with CPAs. Maybe they send us business themselves.
Right.
And I'll send them business as well. I'll bring them clients that have gone through this, and I say, you've done it before. Let me make a recommendation for them to use you.
Okay, great. Well, moving on, Darren, on the information here. So let's talk about the process it takes in order to fund. So somebody signs up today. What happens and how long? We talked about the time a little bit, so 23 days is somewhat normal.
Yeah, usually 3 to 4 weeks between the time they sign up and cash in their corporate checking account. Now that's heavily dependent on the state they're incorporating in and where the retirement account is currently. Because every custodian is different, every account's different.
What's
they all
the
have
slowest
different
state?
rules. Alabama.
Calling
Imagine
you out,
that.
Alabama. You're slow. Pick it up. That's the fastest state. I think Florida's the fastest.
Colorado is the fastest
Colorado's
state.
faster?
Colorado takes about 10 minutes.
10 minutes?
Yeah.
Wow, I should form an entity in Colorado. Okay. All right, so at that point, you got a bunch of things. You got to create the corp, you got to create the 401k plan, you got to roll the money over. What tends to be the hang-up? Or where do people get caught if there is a hang-up?
Usually that rollover. Because some plans will require special letters, like a letter of acceptance, and that's something that can't be created until the 401k plan exists and the corporation exists. Because a lot of times we'll take that 4-week time frame and we'll try to condense it down by doing everything simultaneously. And that is a big wrench in the works, is when we have to issue a letter to the custodian saying, yes, we have a 401k plan, here's the corporate articles and tax ID. So if we don't have those things yet, we can't start the rollover. So that's usually the biggest hang up with any of this, is trying to interact with the custodian and make sure that they understand that this needs to be done today. One of the issues that we're dealing with is the retirement plan industry is very slow. Most of the time, they don't think you're going to be able to access this until you're 60. So what does it matter if they take 2 weeks or 4 weeks?
Right.
Because you still can't touch it for 30 years. So trying to fit that into the financing industry, which is, I need this yesterday, that's very difficult to do. And it's hard to explain that to a custodian that this money has to be moved as soon as possible because we're actually going to be using it in a very interesting way. So that's the biggest hang up. But in general, the more we know about your situation, the states you're incorporating, the type of business, where your retirement account is, the more we can actually prepare for those things and make sure that they don't cause any delays.
Does it get complicated if they're in multiple states, like maybe they're on the border or they're working with partners? Yeah, that's a complication?
Yeah.
Okay. Why do you have to form a company and then also register in the state they're doing business in? Or?
Yeah, usually you have to register in that state, qualify the entity. You might also have to obtain DBAs in those states, and then you have to worry about state income tax. Where are you claiming this income occurred?
Right. Maybe you're lucky you're in California where there's no state income. Wait,
no,
we tax almost more than anybody.
Yeah.
California and New York, right? We're the leaders in taxes. Okay, so we have some terminology. I think we've gone through a lot of this, so we'll go. Are we going to cover this at all?
Yeah.
Okay. All right. ERISA. What the heck is ERISA?
So you talked about the law that makes this possible. That's ERISA, Employee Retirement Income Security Act of 1974. This is what made 401k plans possible, and the language for our type of transaction is actually baked into that from day one. So this has always been a part of retirement plans. It just wasn't heavily used by private corporations or startups until 2001. But you might hear it referenced when you're trying to figure out if this is illegal. When you look at that, they're always going to reference ERISA.
Okay, so QES is the next thing, which stands for Qualified Employer Securities. And I heard, for like a year, I heard you guys saying, wow, it's a QES transaction. I don't know what the heck it was.
Yeah.
So basically, this is when you make it so the 401k plan can invest in your business. So
Yeah.
the QES transaction is the actual moment when money goes from the retirement account to the business,
Sure.
right?
Yeah, so going back to that ERISA law, we have all these different terms that you hear, but the law actually uses the term qualified employer securities. So when we reference that, we're referencing what ERISA said, what the law says this transaction is called. They're calling that employer securities, which means stock that's issued by an employer, and then qualified just means that it's a retirement account. That's their fancy word for retirement account. So
Okay.
that's why
the
you hear
magic
that
moment
word.
you get money. That's
Yeah.
people's favorite time.
Usually when we're talking about QS, we're talking about the structure that has to be created. Like, what type of compliance stuff do we have to create to make this possible? We're getting into the nitty-gritty details of this transaction. Anytime we use a different term is when we're talking at a high level. We're giving a general view. Like, when we're talking about business director retirement account, we're talking about the whole structure. But when we say QS, it's just the transaction itself.
Okay, so now the plan is buying stock in your own company. Does the retirement plan now have voting rights in your company? Or, if you bring on an investor, you have all these things you have to figure out. How much money do they get? Do they get a dividend? Do they have voting rights? I mean, what is...
Yeah,
who controls those levers? Are you making your own decision? Are you voting against yourself? You're going to vote yourself out of management, maybe, as an investor?
I wouldn't do that, but you might.
But I mean, are there voting rights, or is that?
Yeah, absolutely. So
okay, that's
we
interesting.
we use the term stock a lot because we were trying to make sure that we're differentiating this from debt. We don't want anybody to think that they're taking a loan from their 401k or that they're leveraging their retirement account necessarily and leaving it where it's at. We want to make it clear that just like when you buy Apple or IBM stock, you're buying stock in your own company with your retirement account. So absolutely, if your corporation puts anything to a vote, your 401k plan shows up. Now, that's just a fancy way of saying it. Technically, you're the trustee of the plan, so you're still going to vote those shares. If let's say your retirement account was half the owners, and then your business partner was the other half the owner, you would just show up as yourself and just vote. You don't have to go through anything fancy. It's your account. You still control the business. That's no different. But we use that term stock to make sure people understand that this is not debt or any type of leverage. This is actually ownership that your retirement account has in your business.
Okay. All right. So let's talk again about what the investment required to get your own investment, the cost of the service. What's the differences in the prices here? We got $54.95 and $59.95. So it's prior to rollover, after rollover.
So first and foremost, most costs that you run into are a percentage. So when you're getting a loan, there's points on the loan. And if you're investing in mutual funds, your investment advisor is going to charge you a percent of something. This structure does not have any of that. It's a flat fee. So regardless of how much money you have, regardless of what you're investing in, we do the same work for every single client.
We should charge
for
a
the
percent.
same price.
That'd be a lot more money,
No.
right? This is the cheap way for the client. So flat fee.
Yeah. So flat fee is we're going to charge $54.95 for this product. Now that's if you want to pay us with a credit card or a check. Then we'll set everything up after you've paid us. The alternative is if you don't have that
money. That's what most people do, or what do you?
Well,
how's it shake out?
Most people take the easy option, which is I don't want to pay you until later.
Okay, all right.
So
works for me.
We're happy to do that, but there's a lot of risk we take on in doing so because we're incurring hard costs. We're paying for the incorporation. We're paying for the 401k plan. So in order to do that, we're willing to let you pay it after, but there's an increased cost. So $59.95 is for our clients that pay once the funds are in that corporate checking account.
All right, extra $500. I mean, that's not a big deal.
It's a huge convenience.
A few weeks later, right? Okay, all right, awesome. All right, so that's and one last thing, about our service. Again, how are you guys different than the other ways that people do this?
Yeah, so there are promoters that have been doing this for 15 years, and when the IRS came back in 2010 and said, here's how we feel about this transaction, they highlighted a lot of the pitfalls, or I don't say pitfalls, the shortcomings of these companies. So that's what we've really focused on since we got involved in 2011 is the compliance of the corporation and the 401k plan management. So on the corporate side, the biggest glaring weakness we saw is that there weren't corporate kits being issued. Now, we don't want to get into too much detail, but basically when you have a corporation, there is a lot of paperwork and it needs to exist. We talk about the corporate veil, and a lot of that's just paperwork, making sure that there are signed documents for everything that the corporation decided. Now, a lot of promoters out there, they'll just provide templates, or they'll send you your documents on a PDF or a thumb drive, and they'll leave it up to you. Now, regardless of the customer
thumb
service,
drive, man.
yeah, but regardless of the customer service there, that's a huge compliance issue, because at the end of the day, you're probably just not ever going to print those documents, and you're definitely not going to sign them.
Right.
So what we do differently is we actually physically print the kit. We customize it so it's got all your company name and address. You're not having to make changes to this. It's got everything done for you. And then we'll put signature tabs on it so you know exactly where to sign. You just open it up, sign, 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 and you're compliant. So that is the biggest glaring difference between what we offer and other providers.
Okay.
Is that physical kit.
So there's that, and then also, I know that we do more complex things than other providers do. So what are the types of transactions that we shine at that maybe other people don't know what the heck they're doing, right?
Sure. So anytime we're bringing in multiple businesses or multiple owners, usually when you have multiple owners, they don't usually want to let you use your retirement account because they might be giving up some control, or they might have an issue with the tax structure. So this does require a little bit of flexibility that a lot of times isn't available to you when you have multiple owners. Also, a lot of promoters are kind of afraid of the real estate industry,
right?
Because traditionally it's been thought of as something that's passive, but as we look more into this industry, it's very clear that people that are flipping homes or that are managing multiple properties, that's a real active business. And so this is something that I haven't really seen with too many promoters, but it's certainly something we focus on, is the real estate industry and taking on those clients. They're a little more complex, a little more sophisticated, but
no,
I think it's worth it.
I think some people use self-direct IRAs a lot for real estate.
Yeah.
Right? If you have a 401K, could you just make it a self-direct IRA? Is that what some people
you
do?
certainly could do that. And again, that's why traditionally
that's what
that
do,
was
right?
thought of as passive, is,
Okay.
you just buy a property, you rent it out, and the rental income goes back into your IRA. Well, it's a little bit more complex than that. I mean, what if the sink breaks? Can you go
Right.
down and use your Home Depot card to fix that sink? Well, that's considered a prohibited transaction. So we're starting to see that these real estate investments, even passive ones, they're actually a lot more active, and they fit better with the BDRA than they do a self-directed IRA.
Okay, awesome. All right, so I think we have another example. I don't know if that's our last example. Here's a recording studio. Oh, we got a bunch more, right? Okay, real quick, somebody's asking another question. Yeah. What happens after 5 years after the agreement ends? And just to reiterate what he's talking about is, somebody comes on with us, they get 5 years of corporate management where you're reminding them to do their filings, talking to their CPA. What happens after 5 years?
Well, a lot of this is transitioning somebody that's been working for a corporation to somebody that now owns a corporation. So people don't, like I said, they don't know to file their annual report. But after 5 years of telling them to do it, they got it.
Okay.
We don't need to hold their hand any longer. More importantly, though, is the consulting. After that 5-year period ends, we'll still provide that consulting. We're just not going to update your documents or make changes without taking compensation. So, for example, let's say you bring on a new owner. In year 3, no problem. I'll just print the certificates. This is part of the program. But if you come in year 6 and say, I want to add another owner, you might say, you know what, I have to pay an attorney to do that. I need to bill you for their time.
Okay, all right, well, that's a big value. You get that extra work for years afterwards.
Absolutely.
All right, so recording studio, 150 grand. They decided to pay afterwards it was done, so that's why it's $59.95. Time to fund 72 days. What happened here? It's a long time.
Yeah, well, this is actually on the client. I mean, we do work at their pace. So what happened was there was an issue with the location and their lease, and what was weird about it was zoned differently. And I just figured recording studio is the same as any other industry, but it actually
you have to be zoned for a recording studio?
No, not necessarily. But it was zoned, I think, maybe residential, and because of the type of equipment and electrical load, it just caused a lot of problems. So they had permits that they had to get. Those permits took months to get, and so they asked us to put it on hold. So we were halfway through the process, and we set everything aside until they were ready.
Okay, great. All right, so it took a little while. How about Deal Bubble? Deal Bubble.
Yeah, absolutely.
Online superstore. This looks like a drop shipping company to me. Is it?
It's very close to drop shipping. There's a little bit more of a marketing aspect that doesn't always happen with drop shippers. There's a lot more social media presence.
Okay,
and so that's
great.
why I see it as an active business, and was happy to work with Deal Bubble.
All right. So 76 grand in funding, $54.95 they paid in advance. Time to fund 22 days. That seems pretty standard. All right, garage organizing franchise. What can you tell me about this one?
Well, first off, that's a picture of me. So that was my franchise.
Right after a tough
working
workout,
out, yeah.
right? That's your garage? You got the kettlebells there? Good.
Yeah, but one of the things I would like to talk about is franchises. They usually are looking for a commitment up front. So there's a franchise fee. And it's usually a lot of money that people have trouble coming up with. And this is a great way to pay that franchise fee, especially because we will communicate with the franchise if need be. If they're saying, hey, when's this money going to be there? You can give them our phone number. I'll write them a letter or get on the phone with them and tell them exactly when that money's supposed to be there.
Okay, great. Awesome. Well, unless you guys have any more questions, I'll go ahead and wrap it up for the day. Again, if you're new to the show, please like and subscribe. You got to like after this awesome show. Ben, thank you for coming on.
Yeah, anytime.
We'll go ahead and wrap it up for the day. But everybody, we look forward to doing a lot more deals together. And yeah, that's it. Cheers. Again. Cheers number 3.